the running joke in the mortgage industry as we speak right now is we were looking at 0.75, they did 0.5. That difference of 0.25 will be given courtesy of Santa in December, because at this point here, the trust factor with the Bank of Canada is minimal. In my opinion, Michael, this is craziness what they're doing right now. Like, enough's enough. Like, you got to stop. This is not the answer to the supply chain issue, which is the real driver of this inflation.
Oh, it's disastrous. It's disastrous.
We were hearing a 0.75 increase, which continued to have our heads spinning. 0.5 is lower than what we anticipated, but it's still high in my opinion, because if you go back and you take a look historically, for the most part, rate increases have not fixed inflation. Rate increases have not done what the Bank of Canada is hoping it would do. So in essence, what they're trying to do, the Bank of Canada is trying to bring down the inflation rate, which is understandably so. We don't want it in the 6%. We do want it in the 2 or 3%. But raising rates of this nature is doing what? It's basically stopping people from buying and going out and like, not really lending, but in essence, buying on lines of credit or credit cards and whatnot, because what's happening is lines of credit now the rates are going higher and higher and higher and higher. So people are not going to be able to use their HELOCs. They're not using their line of credit, but that's not the issue here. The real issue, to my understanding, is supply chain. And if you don't fix the supply chain issue, raising rates is not going to do anything for you.
What's happening with people that are and have those HELOCs and line of credits and maybe a larger sum, and those interest rates are going down? What can they do to mitigate some of those extra costs, if any?
So it's all about the numbers and what I do with all the clients that are in this situation, because a lot of them are going to be hitting their target right now, right? Their target rate from their bank is like, you know what, now your payment is no longer going to match your amortization. We need to have either a lump sum payment here or increase your amortization. A lot of bank lenders now are taking that amortization originally of 25 years, simply making it 30 years. You just have to go to your branch, or you got to call your bank or your financial institution, and they may simply adjust your account to go from a 25-year amortization temporarily to a 30-year amortization. That's the key word there. Make sure it's temporary, so that when the rates go back down, you can then go back to a 25-year amortization or perhaps something less. That's the key when it comes to situations like that. When it comes to HELOCs, lines of credit, will there be relief in Q1, Q2, or Q3? I believe so. Maybe not in Q1, because we still have the December announcement.
We're not looking at 18, 20% mortgage rates anytime soon. We're pretty much peaking, close to peaking right now. And if anything, you are suggesting once we see a level off, it should drop, correct?
Yeah, well, once you start seeing a level off, that means inflation has gotten down to the 5 or 4%, which is much better. And if that's the case, wonderful. If the inflation, my concern now, obviously, is the holiday season, right? People are still going to spend money. It's the holiday season. People will still spend and buy gifts and whatnot. So really, is that going to change inflation? I don't think so. Q1 of 2023, I think we should start seeing hopefully a stabilization period. And then we'll take it from there. It's funny you mentioned the 18%, because that's what our parents paid back in the day. At this point here, Michael, really, with the Bank of Canada, never say never.
No,
I can't see it happening. As long as inflation, it's dropping. And if it continues to drop, we'll see some relief. We'll see some stuff. When we get back down to where the Bank of Canada wants us to be, somewhere in around mortgage rates around 2 to 3%, if that becomes a situation again, which I do believe it will, I'll be paying close attention to 5-year rates at that point there. And if any of my clients are in a situation where they could potentially sign for a 5-year 1.9, 2.2 5-year rate, I will then have that conversation to bypass variable if I do know that 5-year fixed will not be broken. If it's going to be broken, your penalties are 9 times higher than a variable. That's one of the reasons why I always go variable. Life happens. Things change. I mean, no one could have predicted the pandemic. So when you break a 5-year fix, your penalty is much, much higher than when you break a 5-year variable. Problem is, nowadays people are so scared of variable because of what the Bank of Canada is doing, and I don't blame them at all. You just have to emotionally remove yourself and look financially, figuratively look long-term, and you'll realize that whatever's happening right now will likely change within the next 4 to 5 years. Why do I always say variable? If you go on my site, joeferraro.ca, you just simply search the post that I made there. When you compare the 25-year comparison of variable versus fixed, generally speaking, a 5-year variable will always beat a 5-year fixed, no matter when you take a look at that target. So eventually, it's going to go down. I mean, anybody out there, any economist, does not believe we are going to stay in this high rate environment until 2027. I can't see it here.
Fair enough. Amazing. So if you guys need any information with regards to mortgages, getting pre-approval, anything along those lines, you can reach Joe at joeferraro.com. If you're looking for an evaluation on your house or considering selling in this time, especially during this time, make sure to give me a call. I'll be able to help you out. This is your Mortgage Minute again. Thanks so much, Joe.
Anytime, man. Thank you.
Take care.